We saw gold under pressure today. One big catalyst here may be that the Chinese central bank, which has been buying gold now for the past, or had been buying gold for a year and a half, halted its purchases in May. Perhaps not surprising with gold at or near record highs, but it was quite a buying spree. We are joined now by Christopher Louney, global commodity strategist at RBC Capital Markets. Christopher, it's always great to see you. Thank you very much indeed. So you note in your report today, it's maybe not a surprise that the Chinese would cool their jets with prices at or near record highs.
Yes, and thank you, Andy, for having me back today this Friday. Yeah, the news today coming out of China certainly dealt a blow to gold. We had been warning for quite a while that the rally in gold prices certainly had its vulnerabilities. We have to keep in mind that gold has been trading quite high for quite a while. It's largely been pinned to some geopolitical concerns playing a role in gold prices, strong consumer demand, strong central bank demand, of which China was an important leader. And so that news coming out of China certainly put the pause on some of the gold price performance that we've seen recently.
Can you remind me, has Russia's been a big buyer as well, hasn't it, over the past couple of years?
Yeah, a number of countries have been a buyer, Russia included, India, Kazakhstan, a whole host of countries. And generally, central bank demand for gold has been quite strong. Broadly, expectations are that central banks still have an interest in gold for whatever reason. It's largely due to diversification, efforts to de-dollarize. It's a very liquid asset. All of those reasons why central banks wanted to buy gold and continue to buy gold do remain. But given how high prices are and the long run of strong purchases, at some point, I think that was one of the key vulnerabilities we were watching. At some point, these purchases were sort of bound to slow. And again, especially at record high prices, which make these purchases increasingly expensive to keep up. In fact, if you look at the Chinese data this year, January and February were extremely strong months. But as you saw prices continue to rally, you saw purchases sort of slow going into March and slow again going into April. And then the data that we got about May, which showed no change in holdings, certainly gave the market and reminded the market, in our view, that there are vulnerabilities to one of these key pillars for gold prices trading so high.
I don't think you're a bear on gold, but you say it's likely there'll be better prices for gold later in the year.
Yeah, our view has really been that it's not that gold prices above 2,300 were not justified at some point, but we did think gold was trading too far, too fast. We have to keep in mind, again, this was largely a rally driven by central banks. It was driven by strong consumer demand. You may remember the Costco gold bar stories that we had here, especially in the United States, and more broadly, strong Chinese interests for a number of economic reasons that happened there locally. But broadly, these sort of geopolitical concerns, among others, are really driving some significant interest in physical demand sort of across the board. But we didn't really see investors following through on that. In fact, until May, there was roughly a year of declines in gold-backed ETFs. And that was one of the key signals that there may be some vulnerabilities in the market. Now, while that trend may have bottomed in May, we started to see some increases in the gold ETF buying so far in the few days that we've had so far in June. We are looking at these broader macro drivers. And I think one of the other things that came out today was data around jobs and just seeing how that has continued to push out Fed rate cut expectations, which we're now looking out towards December. We've seen this sort of broadly positive narrative for gold in terms of rate cuts get priced in and priced out and pushed out. And that, again, was another vulnerability that we've seen in gold prices. But even more broadly, rates are high, the dollar is strong. Those things typically aren't strong positive drivers for gold. Those are negative drivers for gold. But it's really been the central banks and consumers that have pushed this rally higher. And that's why, while we're not bears, we're not saying that gold shouldn't be at these prices at some point. We do think it got too high, too fast ahead of these rate cuts going into and throughout this year.
So what did you say about the gold ETFs, Christopher?
So for the gold ETFs, we've seen strong selling across the gold ETF space in tonnage terms, so for over a year, and then we started to see that sort of bottom in May and start to increase more recently. But given how long that duration of sales in gold-backed ETFs was, we're definitely going to need to see some stronger data, more sustained stronger data in that respect to really convince us that investors are now on board with gold at these prices.